Building a dividend portfolio is one of the most popular ways to generate consistent income. Unlike trading, which relies on buying and selling at the right time, dividends reward you simply for holding stocks. These payments come from companies that share a portion of their profits with investors. In 2025, dividend investing is more relevant than ever because people are searching for stability in a world of economic uncertainty. The dream is simple: a portfolio that pays you $1,000 every month, $12,000 a year, without requiring constant trading or speculation. But how do you actually build such a portfolio in 2025? Let us break it down carefully, step by step, in a way that shows not only the math, but also the mindset required. The first step is understanding how dividends work. A dividend is a cash payout per share, often quarterly but sometimes monthly. For example, if a company pays $1 per share annually and you own 100 shares, you receive $100 per year. To reach $1,000 per month, or $12,000 per year, you need to combine enough dividend-paying stocks so that the total payouts equal that goal. This means focusing on both the yield and the reliability of companies. Dividend yield is the percentage of return based on the stock price. If a stock costs $100 and pays $5 in dividends each year, its yield is 5%. Here is the simple math: to generate $12,000 per year, you divide by the yield. At a 5% yield, you need $240,000 invested. At a 4% yield, you need $300,000 invested. At a higher yield, say 7%, you need about $171,000 invested. These numbers can feel intimidating, but remember, building a dividend portfolio is not about reaching the goal overnight. It is about setting up a process that grows steadily until you achieve it. Now let us talk about strategies for 2025. The world is different from 5 years ago. Interest rates have risen, inflation has affected markets, and investors are looking for solid companies with strong balance sheets. This means chasing extremely high yield stocks is dangerous. Many companies offering double-digit yields often have unstable finances and risk-cutting dividends. The smarter move is to focus on quality companies that consistently pay and increase dividends. These are often called dividend aristocrats or dividend kings. Companies that have raised dividends for 25 to 50 years straight. They include names like Johnson & Johnson, Coca-Cola, and Procter & Gamble. Their yields may be lower, around 2 to 3%, but they are reliable. However, for someone aiming for $1,000 per month, a mix of safe dividend aristocrats and higher yielding stocks is required. That is where sectors like utilities, real estate investment trusts, REITs, and energy pipelines come in. Utilities often pay steady dividends because people always need electricity and water. REITs are legally required to pay out most of their profits as dividends, making them a powerful income tool. Energy infrastructure companies also pay attractive yields due to long-term contracts. By combining these sectors, you can build a balanced portfolio that delivers both safety and income. A practical 2025 portfolio might look like this: 40% in dividend aristocrats for stability, 30% in REITs for higher yield, 20% in utilities, and 10% in energy pipelines. This mix balances security with income. For example, suppose you put $200,000 into this portfolio with an average yield of 6%. That gives you $12,000 per year, exactly $1,000 per month. If you have less capital, the key is starting smaller and reinvesting dividends until the snowball grows. Reinvestment is a powerful weapon. If you earn $500 in dividends in a month and reinvest them into buying more shares, the next month your dividends grow slightly higher. This compounding effect can accelerate your journey to the $1,000 per month goal. Many brokers now offer automatic dividend reinvestment programs (DRIPs) in 2025, making it easier to grow without effort. Let us add a real example. Imagine you invest $100,000 across a mix of companies with an average yield of 5%. That produces $5,000 a year, or about $416 per month. Not yet at the target, but if you reinvest those dividends for 5 years and add extra contributions, your portfolio can double, bringing you closer to the 1,000 mark. The beauty of dividend investing is that it rewards patience. Time and consistency are your allies. Another important point in 2025 is diversification. Putting all your money in one company or one sector is dangerous. Even a strong company can cut dividends under pressure. For example, some energy companies reduced payouts during downturns. A balanced dividend portfolio should include at least 15 to 20 companies across different sectors. This way, if one reduces its dividend, the others keep the income steady. But how do you actually select companies in 2025? Look for 3 things: dividend history, payout ratio, and growth potential. Dividend history shows if the company has been reliable. A company paying for 20 years is more trustworthy than one paying for 2. Payout ratio shows how much of earnings go to dividends. If it is too high, like above 80%, the dividend might be at risk. Growth potential matters too. Companies with rising earnings can increase dividends each year, boosting your income beyond inflation. Many investors in 2025 also use exchange-traded funds focused on dividends. These ETFs bundle dozens of dividend-paying stocks into one investment. Examples include Vanguard High Dividend Yield ETF or Schwab US Dividend Equity ETF. The advantage is instant diversification and steady yield. With ETFs, you can build a dividend portfolio even if you only have a few $1,000s to start. Let us picture 2 paths. Path 1, you invest $240,000 at a 5% yield. Immediately, you have $1,000 per month. Path 2, you start with $50,000, yielding 5%. That gives you $208 per month. But if you reinvest and add more savings every year, in 10 to 15 years, you can grow into the full $1,000 per month. The difference is not just in money, but in time. One path is instant, the other is gradual. Both are valid. Of course, risks exist. Dividend cuts are the biggest threat. A company facing financial trouble might reduce or suspend payouts. Inflation is another risk. It can eat into the real value of dividends. Taxes also play a role. Depending on where you live, dividend income may be taxed at higher rates than capital gains. In 2025, smart investors pay attention to tax-efficient accounts, such as retirement accounts where dividends can grow without immediate taxation. Another overlooked factor is emotional discipline. Many investors panic when stock prices drop, even if dividends remain steady. Dividend investing requires focusing on income, not just price. If your portfolio value drops but dividends keep flowing, you are still winning. Remember, the goal is $1,000 per month in income, not short-term price appreciation. Now let us imagine the life impact. Picture this: every month, you receive $1,000 in your account without lifting a finger. That money can cover rent, groceries, or utility bills. It can give you freedom to work fewer hours, travel more, or save for bigger goals. Dividend income is not just financial. It is emotional security. Knowing that money arrives no matter what happens in the stock market is incredibly powerful. So, how do you start building in 2025 if you are new? Step 1. Open a brokerage account with low fees. Step 2. Research dividend ETFs and stable companies. Step 3. Set an automatic contribution plan. Every month, put aside money into the portfolio. Step 4. Reinvest every dividend. Step 5. Be patient. This process is not glamorous, but it is effective. Let us create a sample starter portfolio for someone with $50,000. Put $20,000 into a dividend ETF for broad exposure. Put $10,000 into REITs, such as Realty Income or Vanguard Real Estate ETF. Put $10,000 into utilities like Duke Energy or NextEra Energy. The final $10,000 goes into dividend aristocrats like Johnson & Johnson or Coca-Cola. The average yield might be around 4.5%, giving you about $200 per month to begin. With reinvestment and regular contributions, that grows steadily. For someone with $240,000 ready to invest in 2025, the path is simpler. You can allocate across the same mix, but at a larger scale. The result will be close to $12,000 annually, meeting the $1,000 per month goal right away. This is financial independence in action. The bottom line is that building a $1,000 per month dividend portfolio in 2025 is absolutely possible. The timeline depends on how much capital you begin with, how consistent you are with contributions, and how disciplined you are with reinvestment. It is not about chasing the highest yields. It is about balancing safety, growth, and income. Companies that pay steadily and grow dividends over time will make you wealthier than risky stocks that promise big yields and then collapse. The journey requires patience, but the reward is freedom. Imagine 5 years from now, checking your account and seeing dividends cover major expenses. Imagine 10 years from now, watching them replace a paycheck entirely. That is the vision that keeps investors motivated. To summarize, understand dividend basics, calculate the capital needed, choose a balanced mix of companies and ETFs, reinvest consistently, and stay patient. In 2025, opportunities for dividend investing are abundant. Whether you start with a few thousand or a few $100,000, the key is starting now. Every dividend reinvested is a brick in the foundation of your future income. $1,000 per month is not just a dream. It is a plan, and with the right approach, it is a plan you can build starting today.